Good day, ladies and gentlemen, and welcome to Eagle Eye FY25 results presentation. I'll now hand over to Tim Mason, Chief Executive Officer, to start the presentation.
Good morning, everybody, and thank you very much indeed for joining us. What we're going to do today is talk to you about how we're going to transform our business to scale and grow. A pretty standard agenda that you normally expect from us, except in the area of transformation programs, where what we've done is we've invited 3 colleagues to join us to explain what they're doing to change the business to enable us to grow faster. Starting in terms of where we are trying to get to and what our ambitions are, the first thing is it is a great market. Personalization every year becomes more relevant, more popular, fueled by AI, and it is the heart of what we do. It's why we exist, to transact personal messages. The second thing that we're doing, and we'll be talking to you about, is how we're making the business more SaaS in order to improve margins and scalability, and also to enable us to be OEM ready for our partnership that is developing there. We have an AI business, we have a real AI business, and we'll be talking to you about that. We're not putting AI in here because, well, it's 2025 and you have to, don't you? We do it because it's a real business. It's been running since 2015, and we'll be talking to you more about that and the opportunity of it. I think the main thing, the main difference is the number of routes to market, the number of growth drivers that we are developing as a business. We had one principally in the past, which was the organic development of generating leads, putting those leads through the pipeline, closing and generating sales. We've now got growth drivers, got at least 4 growth drivers, and we'll be talking to you about those and how we think that that makes us confident that we will achieve the 100 million revenue that we've been talking about for a while, and that will be at 30% adjusted EBITDA or better. So that's the outlook for the business. Let's just have a little bit look at what we are and what we do. We are the world's most powerful transaction engine. I've talked about how important that market is. We are the biggest. If you want to get into personalization, Gartner, Forrester et al. Will point you towards Eagle Eye as one of the places to go and get your RFP completed. In addition to that capability, we have industry-leading AI, and we'll be talking to you later on today about how our AI is developing to enable us to do more things in smarter ways. I think the most important thing to understand about our AI is not only does it do the analytics, but it also does the marketing execution. And you have to be able to align marketing execution with analytics. Otherwise, you can't do personalization. You just don't have the capacity and the capability. So you have to be able to do marketing untouched by human hand. And then the final thing is we have a deep retail expertise. I keep trying to find a way of articulating this to you. And I thought that this year, what we would just do is add up the revenue of the key customers. And it is $700 billion of revenue. We are partners with some of the largest retailers in the world, and we are able to advise them what we see in other parts of the world as to how they should be developing their offer. But we really are just at the tip of the iceberg. That's a great, as a lifelong retailer, that is a great list of retail logos. And when we go to one of our trade exhibitions and we put that's the main thing we put up on our purple wall to sort of indicate that you ought to come and talk to Eagle Eye. It's a pretty impressive list, to be honest. But it is just at the tip of the iceberg. It's a huge market. And BCG, McKinsey, and many others continue to point out to the retailers the opportunity of improving return on investment by investing in personalization. Brad Banducci, the former CEO of Woolworths, described it as being a global megatrend. And what Loblaws pointed out here was the point that I made to you just a moment ago, that the thing about us is that because we do it in so many different places, we are able to get people together and they can share with each other in a non-competing way what's going on in the market, what's working, what they might want to do. So one of the things that, for example, these retailers are very interested in exploring with each other around the world is how do they get more funding from CPGs for these personalized offers. If you come to the AIR platform itself, this is the AIR platform in action with Loblaw. Since February 18, with a renewal up to 2008, you can see that we've had this long-term relationship with them. And what we do through time is we develop new capabilities for them to use to improve and develop their digital connection with consumers. 20 million personalized receipts are being issued a month by Loblaw at the moment. And basically what they're doing, as you can see here, if you read, is they're driving people back to the digital assets. You could have had 2,000 PC Optimum points, but you missed out. QR code here, join the app. And it's because one of the things you have to do as a retailer, you have to keep driving the digital uptake to keep the thing live and fresh, which is why you do things like gamification, a form of which is stamp cards. And this was it was a promotion to get, spend X, get a pot, get a pan. And what we were doing was reading the stamp card that powered that. Historically, for those of you who go shopping, you will remember little dirty bits of cardboard and stamps at the till. This replaces that, does it in a digital way, tracks how you're doing, and encourages you to reach the next step. Briefly, Ziad is going to come back and talk about this, so I won't take too long. But really, the purpose of this is to say that we're not talking about AI because we should, because we have to. We're talking about AI because we have an AI business. Untie Knots was founded on AI foundations, basically machine learning capability to pick offers, work out spend stretch, to create affinity. And where we've been going more latterly using generative and agentic AI is to significantly increase our ability to predict affinity and then also to execute promotions efficiently so that you can have this seamless, untouched by human hand progress. Grew by 30% in the year. That's pretty much what it's been doing for the last few years. I predict that this will go further, faster, and is a key part of the Eagle Eye opportunity going forward. So where are we? It's been a less than stellar year, and we would like to have done better. And in addition to that, we had the setback where we lost the contract with Neptune Retail Services. But we did have double-digit SaaS growth. We did have 30% AI growth, and we did have a very strong management of our financial metrics. What we are aiming to show you within this presentation is that thanks to the transformation that we're running and the growth channels that we have available, that we absolutely can get this business to 100 million of revenue at 30% plus EBITDA. And we'll be taking those two sections in the middle there and allowing the executives responsible to show you how that's going to happen. So we are very confident that full year 26 will see material progress. You'll see the recovery. You'll see contracts starting to be signed. You'll see retailers joining us through the OEM. And that will build the momentum that enables us to return to double-digit growth in full year 27. We've had a really nasty setback, but the business itself is in great shape, and the work that we've been doing offers a huge opportunity, and that's what we will demonstrate to you over the rest of this presentation. I'm now going to hand over to Lucy, who's going to do the financial review. Thanks, Lucy.
Thank you, Tim. Morning, everybody. So to kick off on the finance section, as Tim said, our top line wasn't as strong as we would have liked it to be, but underneath we had some strong KPIs for the year. Double-digit SaaS growth in our profit metrics, and we ended the year with a strong cash position and cash generation for the year. Jeff will talk to you later about the investment into sales and account management to reinvigorate growth. We started to see some nice wins coming through. We had 2.2 million of ARR coming from wins and 3 new signings accounting for 0.8 million ARR post-period. Central Retail in Thailand was one of those, and Galeries Lafayette for our first air win in France. But we want to do more, and we know that this business will thrive the more wins we can put in the top of the funnel. And that's because from a deepen perspective, we know we've got a great model. £1 of win can transform to £3 of transact and deepen by that 3rd year. We know that, and we see it time and time again with the retailers that we sign up. In the year, some of the successes have been Morrisons. They joined us in October 23. They started with our loyalty offering, added challenges on, and since then have added more use cases on, stamp cards, continuity programs. And post-period end, they've actually signed up for a trial for personalized promotions, which is an AI product. So it continues to grow. So far, it's gone not from 1 to 3, but 1 to 5. So it continues to be one of our flagship accounts. Woolworth continues to grow its transactions, has contributed to that number itself. And then the next 2 logos that we have on here are both Eagle AI clients. Leclerc has started as a challenges contract, and since this year has added the digital flyer to its products that it takes from us. Tesco's has increased its audience with us for challenges and continues to be a success and has been recognised for awards in the year, and they speak very highly of the services that we offer. So this year we've achieved 109 NRR. At our best, we've been at 120, and our desire is to continue to get back to those levels. The key is putting more in the top of the funnel so they go through that cycle and continue to drive strong NRR. This slide is an illustration of what's happened with the ARR in the period. As Tim said up front, clearly the loss of Neptune has had an impact on the business, and we can see that in this graph here. We've gone from 40 million of ARR down to 34. The key negative impact has been the loss of NRS. But building back from there, you can see the impact of deepen and wins have added back to the NRR number. So 1.1 million of deepen, 2.2 million of wins in the period, and PPS added 2 million as well in terms of its acquisition right at the end of the year. So on an organic basis, on a constant currency, our ARR grew by 5%. But again, we want to do more and we want that to be stronger. When we look at the graph, we can see the concentration mix that has been from 12 months ago. Our top 10 was 74% of our revenue. And now as we exit FY25, that has gone to 64%. Our biggest customer is Loblaws. You can see that there in the purple block. That's worth 14% of our revenue. That one has just renewed, as Tim said, for its 3rd term. And that's a 5-year extension, taking us out to 2030. All the other customers in the top 10 are 10% or less of total revenue. The average relationship length of that top 10 is 5 years, some of them joining in this last 12-month period, but it illustrates sort of the stickiness of our client base. On average, that top 10 has taken 2 products from us, with plenty more to go, which illustrates the need and our desire to get the NRR up higher, which we expect to do so in the next year ahead. Of the top 10 as well, in terms of the percentage of those customers renewing, less than 20% are renewing for the next sort of 4 years on an annual basis. The biggest one in the next 12 months is Woolworths, which is due for renewal at the back end of FY26. The income statement here, you can see here that the direct profit percentage has broadly stayed the same. We've managed our cost base 5% lower than it was this time last year. The reduction is a result of lower bonuses as linked to performance. We've reduced the delivery team by 10 people following the loss of NRS, but also the transformation to our SI model. We have invested into sales, and Jeff will talk about that in the areas that he's invested, which is important for our ambition around growth. That has accumulated with a nudge up by 2 percentage points on our EBITDA, and on an adjusted EBITDA basis, that's moved from 4.6 to 6.6. The amortization impact of IFRS 15 has helped in that KPI. And our EPS, although lower, has really been the big driver of that, has been around the tax impact. We recognised tax asset last year. Now we've got a tax charge going through the P&L, which is that big swing in terms of the line below adjusted EBITDA. Tim talked up front about this desire for us to continue on our journey to 30% EBITDA margin. That is most definitely true. NRS is going to have an impact in FY26. We've taken the steps already around the direct costs in relation to NRS. We've done that, and that has happened at the beginning of the year. And we're underway with our margin enhancement program to hit our medium target of the 30%. So just to take you through some of those elements, as we transition to be more SaaS and our shift away from SI, our expectation is that professional service as a percentage of revenue is going to fall, which will have an overall positive impact on the direct margin percentage, which is at a higher level than the professional services. Ziad is going to talk to you later about the work that they're doing on the platform. This is a very important part of our scalability going forward and being OEM ready, and he'll talk about what we're doing in that area. But my expectation is by the end of the year that our cost to revenue from a GCP perspective is going to have come down quite dramatically. We acquired PPS at the end of the year. At that point, removed 2 of the senior heads. We are currently in a process of reviewing the rest of the cost base, and we expect to see changes in that area in the next 6 months as well. Clearly, those things are important projects that we're underway with, but in addition to that, we will continue to look at the productivity and the effectiveness of the rest of the cost base. And we'll report to you in 6 months on our progress on the overall movement on the margin area. Clearly, as we get bigger and we get more scale, we're going to get operational leverage from the fixed cost perspective, and that will help us then drive to the 30% EBITDA margin. But in terms of the short term, these activities in the 1 to 4 are going to drive our margin and improve it during the year. And we hope to give you indicators that actually we exit FY26 at 20% run rate to give you confidence around FY27 and beyond. I said up front our cash position was strong. We ended the year with 12.3 million of cash after the acquisition of PPS that we acquired for 5.5 million euros. That's had a knock-on effect on the performance of the free cash flow conversion, which was above 100%. And at the end of the year, we also had our HSBC facility of 10 million and the accordion of 10 undrawn, leaving us with a sort of a strong balance sheet as a result. Post-period, we started a share buyback program, which we've set at 1 million. So far, we've acquired 60,000 shares and have seen the share price being managed in accordance with that. And historically, we've seen very small amounts of shares having a detrimental impact on the share price, and hence why we decided this was a sensible use of our capital as we go forward. I haven't seen you since we acquired PPS business, so I thought it was worth taking a moment just to describe what it is and what it brings to the business. They had a product which was similar to the Air platform that they were positioned in both the UK and Ireland, and it brings with them some nice new enterprise clients, which you can see there. Something that they had, which we didn't have, was a product called Promobase. And what Promobase does, it is a national database of national coupons, which when plugged into the retailer allows real-time redemption of those generic 999 code coupons. With that, there's big relationships with the CPGs. You can see some of those there. And at the moment, there's clear opportunity for us to cross-sell that to our existing customer base. And we're also interested in seeing what else it can do in terms of the relationship with the CPGs. Already we're having quite new conversations with P&G specifically around the opportunity both for Promobase to different retailers in the UK, but also around unique coupon capabilities. The team of 20 came across with us, headed up by Les Carter, the CTO. He's engaged and continues to drive the business, particularly in the area of the Promobase opportunity. And we're underway, as I said before, in looking at what further cost synergies we can get with the business. So just to wrap up my section, clearly the NRS will have an impact on revenue and margin, but that doesn't take away from the scalable SaaS business model that we have built and will continue to develop and supports our margin growth. We're underway with this cost management program, and we hope to give you evidence points as we exit this year that it's on track and gives you confidence for FY27 and beyond, returning to the double-digit revenue and the EBITDA growth that you would expect to see from us. The cash is in a strong position, and that just gives us some optionality in terms of we move forward. And all these components are about continuing us on our journey to the 100 million and the 30% EBITDA. So I'll hand over to Tim now to take you through the next section.
Thanks very much, Lucy. So look, before we were impacted by the Neptune Retail Services thing, we were on with transforming the business because clearly the sales were disappointing and we wanted to do better. And this section is about new people transforming the business for the next generation of growth. Watch out for Ziad talking about SaaS and AI, and watch out for Jeff and Al talking about new routes to market and for new sales opportunities. Over to them.
Hello, everyone. I'm Ziad Jamousi, CTO of Eagle Eye and co-founder of Eagle AI. I've been in my role as a group CTO since April, and I'm very excited about the potential I see for our business, what we can do with our stack to serve better our clients and be really a transformation force for the retail industry and particularly grocery and convenience. We are in the middle of a SaaS transformation for our stack that will not only improve our margin by reducing our costs, but also support our growth by bringing a more compelling proposition to retailers. The first and most important topic is bringing Eagle AI and AI technologies closer together, to be able to come to the retail industry with one solution that will help them end to end, from creating offers, personalizing them, giving to the right customer, and executing them at lightning speed for millions of customers. The other bit of the transformation is to leverage what's happening in the AI world, not only in the product, but also in the engineering teams. We have been adopting Codex just 4 weeks after it was released by OpenAI, and it now enables our engineers to code faster and generate codes by prompting an AI. Along with that transformation, to get our stack ready for the next stage of our growth, we have adopted a new language, Golang, and a new Google native microservice architecture, including some of the most powerful bricks of the Google Cloud stack, like Spanner. We are, in parallel to that, building and documenting our APIs to facilitate partner integration and make it faster to integrate our solution at new clients with the support of external SIs who can, with a clearer API structure and documentation, be able to implement our solution at any retailer across the globe. Finally, this stack will get us into more automated and more granular auto-scaling capabilities, making sure that the cost of the database that we are using, the cost of the service we are providing to a customer, is clearly adapted to the consumption and is responsive to any peaks of activity they might encounter, like Christmas, Black Friday, or any unexpected moments in their business year. So these changes in the stack will increase scalability, reduce cloud spend, make us more effective as a team to develop new features and products, and all that while improving security. We expect from that better profitability, but also higher win rates with our ICP targets. I want to take you into a slightly deeper dive in how we want to incorporate more AI in our platform. The most obvious usage of AI that we have been doing for years now is AI that serves personalization. AI that defines what people should be receiving as an offer, what threshold they should be having, what level of discount they should be having to optimize retailer budgets and ROI. We have accelerated over the last year the speed of delivering new models in our stack, again by leveraging Google Cloud technology like Vertex AI. We are deploying some of the most powerful models that are available for the industry that we have adapted from other industries like Netflix or Spotify and tuned to the retail world, to the reality of the retail world. So those models are now not only implemented on our platform at scale, but we have also the pipelines to implement the next ones much faster than we ever did before, thanks to the pipelines we've built. But we don't want to keep AI limited to that part of our technology. We want to bring AI into the AI world. We want AI to be part of the UX of our platforms. We want AI to guide consumers, customers, into the usage of our dashboards, of our technology. The important thing, as I mentioned earlier, is also getting these two words closer together. The world where we define the right offer for the right people, and the world where we executed. We want that story to be one story. We are bringing that to life with personalized promotions that now can be run seamlessly by our clients through the whole stack without having to do step one in one platform and step two in the second platform. So that's now available for our clients. We should be seeing results as early as September. And we are hearing very, very positive feedback in the pitches with prospects about that concept of one personalization platform. Eagle Eye is in a great position with this big transformation that the technology businesses are facing. AI, because we have a team of 35 people that have been practicing AI since the creation of Eagle AI, that was formerly Anti-Knots. We have been working in that space for 10 years now and evolving as AI has evolved along those 10 years, and it has evolved quite a lot. And we are at the intersection between that deep expertise and experience of AI and a very strong retail knowledge. So we are in the best possible position to build the most impactful features for the retail industry, because we know how to do AI in our world, and it doesn't work the same as it would for Spotify or for Netflix. And we know what retailers actually need, so we can be relevant and effective with AI in the retail industry, and we can be the spearhead of promotion and loyalty transformation in retail.
For those of you who I have not met, my name is Jeff Baskin, and I'm the fairly new Chief Revenue Officer here at Eagle Eye. I started exactly 5 months ago to the day. While a few bumps in the road, I'm extremely excited about the progress we've been able to make in just a few short months. My initial observations when I arrived at Eagle Eye have proven to be true 5 months later. The culture and the people that make up Eagle Eye is a huge benefit to the company and, more importantly, to our customers. It shows up in our partnerships and strong relationships we have built and continue today. We've made some changes within the revenue organization to upgrade the team and continue to work to get more A players, which will be crucial to our success in 26 and beyond. We have transitioned some people into new roles, let go of some underperformers, and most recently have brought on a new head of customer success in North America and looking to hire for some key roles in sales and partnerships as well as in the US. Being here in the States and knowing the market very well, I am very confident that there's a large opportunity to be had here in our core ICPs. There's also strong growth available in EMEA and APAC, as proven by the recent multi-year high six-figure deal we recently signed with Central, which is one of the largest retailers in Asia. This recent partnership will help open up a lot more doors in our Asian market and help us grow in that area. The go-to-market strategies and motions are a bit different in each of our regions, so we'll need to focus on how we attack both net new customers as well as our upsell and cross-sell growth within those local teams. One thing that was very evident to me right away after joining several customer meetings, we need to take a more consultative approach in our selling and our customer success areas. Many retailers don't have the expertise or knowledge to run a successful program, so they are looking for a SaaS partner who can help them be innovative and grow faster. As our AI solutions continue to mature, I believe we are at the tip of the iceberg when it comes to retail media and monetizing that trend, especially in the US. Most retailers are building out their own retail media agencies to take further advantage of the CPG dollars to run campaigns that can not only drive awareness, but also add incremental sales growth and provide attribution, which our AI allows them to do. We have started with a walk in your retailer's shoes approach, and thus far it has resonated in a very positive way. Based on my experience as a go-to-market leader in the retail tech space over the last 20 plus years or so, and with the help of a cross-functional team here at Eagle Eye, we have taken those learnings and have officially launched the new Eagle Eye Revenue Journey. At our annual revenue team kickoff event in London, we laid out the blueprint for success of a strong go-to-market strategy That starts with driving awareness, or flooding the market, as I like to call it, to winning more net new deals and getting our NRR back up to 120%. The revenue journey includes a new, more rigorous sales approach, strategic customer action plans, marketing and customer success strategies that will all be driven by 4 core metrics: increase in win rate, reducing our sales cycle, increasing our average deal size. And right now, I believe the most important thing is to increase both the quantity and quality of our pipeline. We absolutely have to win more, but we need more quality deal flow in order to hit our targets. In North America, I often describe Eagle Eye as a startup with a giant head start. We have some of the largest retailers in the world and several in North America who are all referenceable customers. Yet we are still not the household name that we need to be in the States. Through my network and the network of many others, as well as some of the new marketing initiatives that we have undertaken, for instance, a webinar that we hosted with Petco, Giant Eagle, and Google, we've been able to drive several net new leads in grocery, retail, and convenience. Since April, we have grown the North American pipeline by over 15%. And those opportunities are beginning to move through the pipeline at a very good pace. If and when we land these new logos in the US, I believe it will create significant awareness and momentum in the industry, which I believe will be a springboard for our business in North America. US retailers in general are under more pressure than ever from Amazon with their recent announcement of same-day delivery on fresh items throughout the rest of the store, but even more so from Walmart. 90% of Americans live within 10 to 15 miles or 16 to 24 kilometers of a Walmart, not to mention the enormous investment they have made in omnichannel operations and customer experience. Other retailers need to move fast and utilize AI solutions like challenges and personalized promos to attempt to catch up. Eagle Eye can't just be loyalty anymore. We have to be a one company where we are the loyalty, personalization, and AI experts that every retailer needs to work with in order to create a great customer experience to thrive and compete with the likes of Walmart and Amazon. As I mentioned, I'm really pleased with the fast progress we have been able to make. We are putting people in the right positions, and with some of the recent moves we have made across the revenue team in the US and around the world, I believe we can accumulate some significant momentum as we aim to hit our goals for full year 26 and beyond.
Good morning, everyone. I'm Al Henderson, Chief Partnerships Officer here at Eagle Eye. I'll be discussing our exciting progress, focusing on 2 key areas: our OEM strategy and partner channel momentum. First, let's talk about the OEM and the significant growth driver that it represents for us. To recap, our Air platform is embedded within one of the largest software providers in the world, with a large global customer base who need to migrate from an on-premise solution to a cloud-based solution. This initiative has the potential to double our business by opening up new sectors and geographies, addressing pent-up demand from the existing customer base they have. We've achieved key development milestones, and the vendor has successfully previewed the product at 2 global customer events. And we know there are at least 25 large enterprise scale prospects, their existing customers, that are due to be the first customer candidates. They're looking at diverse sectors like travel, hotel, luxury, CPG, which takes us beyond our traditional ICP, beyond grocery retail. And again, this represents a significant increase in scale and strong progress towards our goals. Right now, the vendor is skilling up their sizable commercial team, which is actively being enabled ahead of general availability, which is confirmed towards the end of H1 FY26. And we anticipate material revenue generation from FY27. Our partner channel is building significant momentum. We have major partners on board who are actively contributing to our pipeline and deals. In fact, 31% of the global pipeline is either referred or influenced by partners, and 90% of that coming from systems integrators across all regions. Opportunities brought to us by partners have generated 42% of our FY25 win ARR, with Google being a major contributor, leading to Eagle Eye achieving premier partnership status. We've delivered a suite of new technology partners in FY25, and Eagle Eye Connect is enabling a scalable approach to strengthening our win message, as evidenced by contract wins with Green King and Coke restaurants. We've signed 4 global recognized systems integrators in FY25, secured our first systems integrator partner deal with Galeries Lafayette in Paris, and successfully launched our systems integrator partner program in June 25. Our referred ARR is more than doubled year on year, and our referred win ARR is more than 2.5 times year on year, demonstrating the incredible growth and effectiveness of the new partnerships team. In summary, we're making tremendous strides with our OEM opportunity, expanding our partner ecosystem, both of which are game-changing, and I have no doubt that they will transform the business. We're well positioned for significant growth and continued success.
Thanks very much indeed, guys. So I hope that you can see there that what we're talking about is investment in the product, a real understanding of AI and an investment in AI going forward, a significant investment in sales, particularly in North America, but also in Europe, and some realignment of resources, and an investment in partnerships. You know, all those new people who are partners, each one of those takes investment. There's a tremendous opportunity for Eagle Eye to be a significant growth business, as we were historically, and which we are determined to return to. We've had a setback, but we cannot turn our back on this opportunity. It is my responsibility to deliver it, and this is really how we do it. In terms of the green block that you see there, air keeps growing. In terms of the yellow block, accelerated by partnerships. In terms of the purple block, the USA itself is a significant opportunity over and above the organic plan. And I hope you got some encouragement and excitement from Jeff there. Eagle AI is a great business. It'll keep growing at 30% plus in my view. And actually, I think that will accelerate going forward. And then we have the whole new opportunity of the OEM coming on top of that, which, as Al said, has the potential to double our business. So we have a lot of routes to growth and a lot of reasons to be positive, but we've got to spend just enough money so that those things can deliver. Trading has started well. We're confident that we can manage the margin, but half one is going to be tough. The SaaS transformation is underway. We are an AI business. I hope Ziad gave you the impression that we really do understand this stuff. It's not something we're sticking on the top of ourselves, you know, as a must-have. It is the way we work. We've got a lot of partners on board. The OEM agreement is in place and is hotting up all the time. And I think we've strengthened the team. So I hope you feel, as I do, confident that Eagle Eye can get back on the growth trail.